Right, good day grade 12s. In the second lesson on fixed assets, we are going to revise the fixed asset note that you again did in grade 11, but asked to compile parts of it, or you could be asked questions on it and you have to analyze or find missing figures on it. So we've already completed in the first lesson the ledger accounts. So we're going to use those exact same ledger accounts. So you need to take out that information that you had. And from that, we're going to draw up the fixed asset note. Now, what I want you to do is either to take out your answer book for the new era, task 7.1, or if you don't have one, then to just please freeze the frame and just draw up a fixed asset note, or to use another one that you've got in another answer book of yours. So there's a copy of it, so please just complete that before we can carry on. Right, now this note is an extremely important note. So just before we start filling in figures, just remember that it starts off with the beginning of the year. What was the situation at the beginning of the year? The movements is what has happened during the year to those particular fixed assets, and you end up with what's the end of the year. So to start off with, let's start at the beginning of the year. And remember, in the actual textbook or in the ledger accounts that you were given that the vehicles had an opening balance at cost of 390 and the accumulated depreciation was 108,000. And so it's just a case of filling in those figures. Please, whenever you're going to subtract in a note, you must put it in brackets. So subtract those two and you get the carrying value at the beginning of the year is 280,000. Then during the movements there can be three things. First of all, they can buy a vehicle. And in this particular exercise they didn't, so we didn't have anything to fill in, but you must obviously fill in, and that affects the cost of the vehicle if they do buy. Then the next thing is the disposal. Now what's very important with this disposal, and if you read here, it's a disposal at carrying value, at the book value. Now this you can find in two different places. If you went back to our original sheet, we already worked out that the book value was 39,000. Remember, that is the asset that you're selling, the cost price minus the total depreciation. Or you could have looked at the asset disposal account over here, and there it is, your vehicles at cost of 90,000, the accumulated depreciation of 51,000, and so there's your disposal, 39,000. Now that figure, please focus on it. It is the actual carrying value, not the selling price, not the original cost. It's what its value is on the day that you actually sold it. Then the next thing is to bring in the depreciation for the year. And again, we have completed the ledger accounts. Now remember that this note has been done at the end of the financial year. And it was for that reason that we had to bring in the total depreciation on our assets, not just the one we sold, but also the one we kept. Or, remember, we did it in the sheet that we had here, where it just made it easier to understand. The asset that we sold, we had for 10 months. We'd worked out the depreciation was 15,000. And the old asset, which was the balance, the 300,000, we've had for the whole year is 60,000. And so your total depreciation then for the year is 75,000. The final figures at the end of the year are the closing balances. And for this, you go back to your ledger accounts. The vehicles account, after minusing out the one you sold, has got a cost of 300,000. Your accumulated depreciation, after adding on the depreciation and minusing out the depreciation on the asset you sold, you've got 132,000 left over. And those are the two figures that fit into the bottom over here. Now, the problem does come with these final figures over here at the bottom if you did not do the ledger accounts, if you've only got this information in front of you here. And that is, first of all, the cost. You start with what you had at the beginning was 390. If you had bought anything, you would have obviously added it on. But what you've got to remember is that you sold. So you've got to minus away from it the cost price of what you sold, which was the 90,000, which you can find in your asset disposal, and therefore that gives you the 300,000. Likewise with the accumulated depreciation, it's reconstructing that ledger account, but if you didn't do it, you have to do it in your head. So you started with 108,000. There was an extra 75,000 depreciation, which was the one that you sold, plus the one that you kept. And then very important, and this is the one that everybody forgets, is that you must minus out of that the accumulated depreciation that you minused out of this accumulated account. Remember, you transferred that to the asset disposal account. So your asset disposal account brought in a figure of 51,000. And so you have to minus that 51,000, and that gives you the 132,000, and then the book value of 168. This is where you're going to go wrong. So make a big note next to it and say, right, I must remember that. Now, to complete that fixed asset note, we also have to look at land and buildings. Now, those of you that don't have the book, just pay this particular attention here. You are given a land and buildings figure of 1,080,000 here at the end of the financial year. You are then in adjustment number 2 told that an additional storeroom was built during the year for 120,000, but was inadvertently or by mistake entered under repairs. Now that is a mistake because a storeroom is an asset. It's not an expense, so it doesn't appear under repairs. You'd have to, in your income statement, take it away from repairs, and you've got to add it onto vehicles. So therefore, this 120,000 has not been entered into our books here. And so the cost of your land and buildings at the beginning was 1,080,000. Remember, there is no depreciation, so your book value is exactly the same. To correct the error that's been made, you will minus the 120 away from repairs, and that's your addition. That's how your land and buildings change during the year. And then add on, you've got 1.2 million at the end of the year as the cost and the carrying value. Now, a typical exam question would be, for example, to give you the opening and the closing figure and leave out this. This is where I said to you in grade 12, you're not always going to be completing, but you're going to have to find missing figures. And obviously the missing figure would be the difference between that. So look out for that. And then the last thing is to look at the equipment. Now, you're given that equipment is 174,000 at the end of the year again on the last date, and you're told that the accumulated depreciation on equipment, and just take note the date here. The date was the beginning of the year, was 42,000. Now, it tells you in adjustment number 1 that additional equipment was bought on the 31st of August for 40,000 and has been recorded. Now that is an extremely important sentence there, and has been recorded. It means they've already added it on to the equipment. So when they give me this figure of 174,000, that already includes this 40,000. So therefore that is not the beginning of the year figure. These 3 words here change it totally from what happened with the land and buildings, because the land and buildings they had not recorded it. They'd recorded in the wrong place, but they had not recorded in land and buildings. So that 40,000 was included in that 174, which means then that my 174,000 is actually my end of the year figure. The addition during the year was 40,000, and if we subtract the one from the other, we had 134,000 at the beginning. 134 plus 40 gives you the 174, because the 174 includes the 40,000. Now, if you didn't see that, make a note for yourself in the book to watch for that. The accumulated depreciation is not a problem because they specifically told you it was at the beginning of the year. So the 42,000 can come in and you can subtract and get the book value. And then lastly, we have to depreciate the equipment, and it's 15% on diminishing balance method. Please make sure that you know the difference between cost and diminishing balance. This was taught to you right back in grade 10. So if you're not sure, please go back in your books and do a quick revision on this. Now, the diminishing balance is the same as the book value. Now, what we've got here is we have to look and say, right, I had 92,000 diminished balance book value at the beginning of the year. That 92,000 has to be depreciated by 15%. And as I didn't sell any of it, I've had it for the whole year, so 13,800 is the depreciation. But we bought another 40,000 during the year. Now, as this has just been bought, it's never had depreciation written off. So in the first year of depreciation, we can only depreciate on the 40,000, which is the same as the cost. Still the 15%, and it said to us that we bought this on the 31st of August. So you've had it for 6 months. Again, pay particular attention that you're getting the months right. 6 months, which is 3,000. And so your depreciation is 16,800. All right. This workings must be shown, because there's a lot of marks on 16,800. And if you do it on a calculator and you don't show your workings like I have been doing here, you could be depriving yourself of a lot of marks. And then finally, we've got the cost. The accumulated depreciation was 42,000 at the beginning. We add on the extra 16,800. And because we didn't sell, there's nothing to minus. So it's just the two added together to give you the final figure. This note, I can't stop telling you how important it is. You are unlikely to be asked to draw it all up in grade 12. But you will be asked to find certain figures. And to be able to do that, you've got to draw up the whole thing. So again, I've taken you through an exercise. Now I want you to go back to continue with your revision on the ones that you did the ledger accounts and complete the fixed asset note.